The date is Saturday, May 10th. This is a stockhaven.com webinar. My name's Kevin Kleinman. I'll be answering questions submitted by you guys. So let's get to it. And I'll be posting all text questions in chat so you can hear what I'm answering to. So first question I received was, what are my thoughts on placing strategies such as straddles and strangles, say a week or more prior to earnings, in likely anticipation of a rise in implied volatility, and then selling off your position before the actual earnings report? This can be an effective strategy, and it's a strategy that a lot of traders employ themselves. The key, though, is you need to choose the right stock and the right option strikes to play it. And this type of strategy is often referred to as exploiting earnings volatility. And the strategy involves buying a strangle or straddle and hoping to profit because of the increase in implied volatility in the run-up to earnings can turn the trade profitable. And what it is it's essentially a balance between the positive effect that implied volatility rising has versus the negative effect that theta or time decay has. When using this strategy, there are a few things you should look to do. First, you want to choose a stock that has a big history of big moves on earnings, typically at least 6% or so for the last few earnings. This will ensure that the market prices in a big implied volatility increase. So a stock like Tesla, which has made big moves off of its recent earnings reports. Here's one. Then your most recent move was a major move to the downside. You had a big move back in November to the downside. All right, so Tesla is a good stock to use as an example of a stock that makes, or recently anyway, in its history, has made big moves off of earnings. So you can bet that next earnings report, the market is going to be pricing in a big move in Tesla, most likely, so that will have implied volatility increasing. Now, the next thing to consider is the timing of when you buy your position. To me, I think you want to buy the position about 5 to 10 days before earnings, because in my experience, implied volatility typically starts to rise significantly about 18 to 21 days before earnings. However, if you buy too early, then theta can ruin the trade. But if you leave it until too late, then you can miss out on the biggest part of the implied volatility move. Next, if you choose a strangle, you mentioned straddles and strangles, this is specific to strangles. If you choose a strangle to play this strategy, then make sure you always choose strike prices that are the same distance from the underlying strike price. Or sorry, not strike price, same distance from the underlying stock price. Remember, it is a directional neutral trade that you're putting on, and your only aim is to collect profit from IV premium, not direction. You're on both sides, so you're not concerned so much with which way it goes. You're just concerned with implied volatility increasing. So for example, if Apple is trading around 600, then you would want to buy the 590 puts and the 610 calls, both $10 away from the underlying stock price. The last and final thing you want to consider is you want to check an implied volatility chart or implied volatility history of the stock you are thinking of playing, and see how much the implied volatility has moved in response to previous earnings run-ups. This can give you an idea of how much implied volatility you can expect to be added this time, and see if it's worth it to make the trade, although obviously there are no guarantees that history will repeat itself exactly when it comes to implied volatility rising. So those are the 4 things to check. You need to see a history of big moves, the timing of when you buy the position. I recommend 5 to 10 days before the earnings. If playing a strangle, making each strike about an equal distance away from the underlying price. And then number 4, checking the IV chart to make sure that there has been good responses in IV, because that is what you are trading the position on. As far as my actual thoughts around it, I do think it can be profitable. I think if it's something you're interested in, you should experiment with it either on paper first or with only one contract. I know sometimes paper trading, myself personally, I've been practicing after hours trading on earnings plays, and what I've been doing is just buying like 5 or 10 shares. For instance, on Tesla after hours, I traded 10 shares, only had $400, or no, I traded 2 shares. I only had $400 or so in the trade. So the most I was going to make was $10. The most I was going to lose is $10. Might seem kind of pointless, but you know what? It gives me real emotions in the trade, as opposed to paper trading. It's not real money involved at all. So that's my take on that. But for you, I'd either paper trade the strategy first, or maybe you're like me and you want actually at least some money involved, just so you can get better stimulation when it comes to how your emotions are really going to react in the trade. Just use a very, very small amount of money relative to your portfolio. And if you like what you're seeing with your test results, then by all means, look to incorporate it into your strategy. Trading is a big tool belt, and the more tools you have on your belt, the better you will be to have success on a consistent basis. And this is certainly one of those tools that you can consider adding to your belt. Next question, also dealing with options. With spreads and verticals, how common or likely is it where you could be assigned for the portion of the leg that you sold? Is it better to sell off a losing leg as you anticipate the underlying to go in your direction, or just the entire position itself? And the assignment possibility is the one major concern in which it has prevented me from utilizing such strategies. I don't fully grasp when that could happen, or why, and what to do if it does occur, as I've never seen a real life example, so any insight on this would help. So first things first, tell you right now, it is extremely unlikely that you will be assigned for the short portion of your leg unless you hold it until expiry. Options rarely get exercised before expiration, because exercising early means that the owner of the option is essentially giving away premium. So if you really wanted 100 shares of the underlying stock, he would be better off just buying them on the open market and selling his option. But even in the unlikely event that your option is exercised early, you can always just cover your short by buying that option back on the open market. And I would not let this affect your decision making when playing spreads. Regarding selling of the losing leg, well, this really depends on your strategy and whether you are in a credit spread or a debit spread. The plus factor of ditching the losing side is that if the stock moves the way you want it to, then you will make more profit. However, the downside of ditching the losing side is that you have just ditched your protection. So if things start back against you, you are no longer going to be hedged on that losing side. So in a credit spread, depending on the level of options functionality that your broker has given you, as well as your buying power, you also might not be able to sell your long position and keep the short position, because that would leave you naked, and some brokers do not allow that, I know, without just a ton of capital in the portfolio. But in summary, I would not let the fear of being exercised stop you from playing spreads, because it's very, very unlikely that this would happen. and even if it does, it's simple to combat by simply buying back your short option on the open market. Spreads are a balance of risk and reward, so if ever you're ditching one side of a spread, then when you are halfway through the trade, yes, you can potentially give yourself more reward if it keeps going in the favorable direction, but it also increases your risk if it stops and then turns back around on you. So a lot of subjectivity involved, and it's really kind of a trade-by-trade basis. Next question I received was relative to level 2. How can you tell when to short a stock when looking at level 2, and how do you hit the ask and bid when trying to buy the stock? Well, I did a ton of level 2 analysis in my last webinar, so I'm going to refer you to that video first. I'll provide some comments on level 2 still, but I'm not going to do a whole lot just because the information you need is already out there. So the video you need, I'm posting it into the chat room now, and you want to start at the 31:35 mark in the video, and that will go over a lot of level 2 as far as how to tell when to short a stock when looking at level 2. But basically, in summary, what you'll gain from that video and the way you want to think of it, as one of my Watch Him Trade subscribers put it really so accurately this past week, is that level 2 is kind of a mini battle going on at all times. It's a mini battle going on at all times. The bulls and bears are always fighting with each other in that battle, and you observe the fight by seeing if bids are racing higher, taking out asks quickly, in which case bulls are winning, or if asks are racing lower, taking out bids quickly, in which case the bears are winning. Or if neither side is really moving the stock up or down, then no one's winning. You're just kind of neutral. So you want to get a feel for that battle and who's winning, and if it's the bears, then that is when a stock looks like a short when looking at the level 2. But again, though, please watch the video I linked in starting at the 31:35 mark, because I go over actual level 2 footage that will help you with this question, and I provide live commentary, so you'll gain more insight into what I'm seeing on level 2 and how you can identify shifts from the long side to, okay, now it's time to be on the short side from observing level 2 action. The second part of the question, how do you hit the ask or the bid when trying to buy a stock? I'm not really going to be taking freestyle questions. It was very clear that questions had to be submitted beforehand, so I apologize in advance if you're asking a question and I'm just kind of ignoring it. So as far as, hitting the bid or hitting the ask, you always want to be using a limit order on a stock. Now this is TradeStation, so my platform probably looks a little bit different from your platform, but here's my level 2 on a Netflix 320 option. So if the bid is 430, the ask is 445. So if I wanted to hit the ask, I just double click on the level 2 ask, and here you can see my limit price, 445, and I would buy that position. Or if I wanted to try and get in at the bid, I would then also use a limit price and try and buy it at the bid. The way to do either, though, is always going to be with a limit order. If you'd like to try and buy lower, beneath the current bid, then you'll simply place a limit order lower than the current bid. So maybe these Netflix 320 puts, and again, it's the same thing with the stock. Maybe you got a stock at $9, or maybe it's a penny stock at 10 cents, and the bid is $8.55 or 9 cents, or in this case $4.30, but I want to get in lower, so I'm going to say, you know what, I don't like this price here. Netflix is around $3.28. I'd rather short it around $3.30, so I'm going to wait for a move up to $3.30, so I'll place my limit order at $3.80, okay, and try and get filled on the bid. The key with filling on the bid, in my experience, is that you should have your order placed beforehand. You shouldn't watch the price, go up and down, and then in this case here, if these puts then go down to $3.80, I shouldn't then try and put my bid in, because I kind of just missed my opportunity to get filled. If my bid was already in, I have a much better chance of getting filled. The thing people do, though, is they get scared. When their bid starts to get approached, they actually get scared and they think, oh, well, do I really want this position? Well, are you confident in the trade or not? Why are you making your trade in the first place? If there's good preparation into your trade, there needs to be good execution, and you need to have confidence, and you need to know that if it goes against you, you're going to be stopping out with a small loss anyway. And with all of that certainty, you should be able to place a bid below the current bid and get filled if it does what you need it to do. As far as, Netflix, I need to go from $3.28 to $3.30 in order to fill a lower bid. Obviously, there's no guarantee that you will get filled if your bid is below the current bid. But I think one of my strengths as a trader is I'm pretty good at getting really good entries, because I generally sit bid, and the bids will go from $4.30 down to $3.50 in a flash in less than 60 seconds, because a move will happen. And if you've got a bid already placed, you're going to fill, and when it snaps back, now you're playing from ahead. Whereas if you don't have the bid placed and you're trying to place it at the time that the move is happening, maybe you get scared, or maybe more likely you just don't get filled. You can use market orders to hit the ask or hit the bid. Using a market order will get you in at the current ask when buying, and out at the current bid when selling, pretty much right away, 80 to 90% of the time. However, in penny stocks, I never used market orders, so I recommend not ever using them. In option trades, though, I use market orders quite frequently when trying to exit a position, but I generally only use limit orders when trying to enter a position. Next question. Is there a sweet spot or magic number in the amount of shares you buy when doing penny stocks to make a profit, or is there a number that you should invest just in general to guarantee that you're going to make a profit? Well, number one, making a profit has nothing to do with the amount of shares you buy. I hope we all know that. It has to do with the trade you're trying to make, and is it a good trade or is it not a good trade? So to me, there's no magic number. It's all about portfolio allocation, how you use your capital, and how you build positions and stuff like that. So I would encourage you to watch the video that actually got posted this week called "What is a Realistic Profit Goal for a $2,000 Account?" And I'll have that video here for you. I will post it to the chat. I think you'll find some very useful information. It's just about 5 minutes long. But again, what is a realistic profit goal? What is a realistic weekly profit goal for a $2,000 account? Now, I prepared the video with options trading in mind, but the concepts I discuss is easily applied to penny stock trading, because really, this question has everything to do with your current portfolio value and your personal goals and just allocation. Like I said, nothing to do with a magic number. The key is proper allocation strategies. I have a $27,000 account, but it is extremely rare for me to have more than 1 to 4% of my entire portfolio exposed on any one trade. So in general, that translates to principals on my positions of about $270 to $1,100. And you can ask my subscribers, I don't think they see me ever using more than that amount in a principal trade. And that's what I'm referring to when I say proper allocation strategies. I only have 1 to 4% of my portfolio exposed, so I'm never going to have a blowout loss if that's, how I'm trading. I might have a bunch of small losses, but I'm going to always avoid that one huge loss, which is the key to, being in a position to then make consistent profits. Now, when I would trade penny stocks a couple years ago, and even when I still trade them today, I follow the same allocation strategies, but when it comes to the number of shares, I always make sure that that number ends in zeros. So, for instance, if we just pretend that these Netflix 320 puts are stock, the quantity I would buy would always be 5,000 or 10,000 or 25,000. And the reason that is because it just makes it easier to keep track of my position, where if I want to sell half of my position or something, I'm not needing to bust out a calculator to figure out, hey, what is half of 39,847 shares? I'm always buying easy numbers. I'm always buying shares in numbers that are easy to keep track of, because then when I go to sell it, it just makes the whole process easier if I want to maybe keep 25% or keep 50%. All right. So, and I would encourage you, and I go over this in the video, don't think of profit targets in dollar terms. Think of profit targets in percentage terms. You want to be targeting, I would think, at least 20% gains. If you're trading penny stocks, if a penny stock's not moving 20%, then it's not moving at all to me, and I'm not even trading it. So you want to be targeting at least 20% gains. Guys, the chat room, in the email when you received the registration, you got the link to the chat room in there. I see somebody on GoToWebinar asking how to access the chat room because I'm posting videos in there. So I just posted it on the GoToWebinar, posted it in the email as well. Where was I? Oh, and they're making a good point in chat too. You need to factor in your commissions here too. You don't want to be buying a couple $100 worth, and you make 20%, so you make $40 off of a $200 trade, but you paid $10 each way, so over 50% of your trade went to commissions. That also definitely has to do with your allocation strategy. You need to be able to make a good percentage trade after commissions, and a lot of that really has to do with your broker. Don't let your broker screw you. If your broker is ripping you off on commissions, tell them you'll go somewhere else unless you get better commissions, and if they don't give you better commissions, then go someplace else. I'm paying $1 per trade on TradeStation. I have trades sometimes I'm paying $1 per trade. I used to pay $15 per trade with E-Trade per round trip, essentially 10 to 15 bucks. So I have trades where legit I used to make a $40 gross profit on E-Trade on a trade, and half of it would go to commission and only be 20 bucks. Now I'm keeping $38 of that. So there's some trades now that I can actually make that I wouldn't have made before with E-Trade because they just wouldn't have made sense for me after commissions got accounted for. So that's a good point that I forgot to factor in to this answer. But I was talking about focusing on percentage terms as opposed to dollar terms. You want to be focused on percentage profits because over the long haul, that's what's always going to be consistent. The money's always going to change, but if you're able to keep your percentage gains and losses consistent, ideally small losses and big gains, then as the money increases, it's just going to become exponential due to the consistency you have behind your percentage returns. Bottom line though, simple answer, no. To me, there is no number that should be invested. There's no set number of shares that is the threshold. It's all subjective. It's all relative to your current portfolio value and your personal goals. My only advice is that you keep it an even number. Keep it a round number that's easy for you to keep track of when you're managing the position. I did not have to negotiate the $1 with TradeStation. That just comes standard. You can either pay $1 per contract or per trade, or like 0.4 of a cent per 1,000 shares. Or they have a couple different commission structures that you choose at the beginning, kind of based on your trading style. Next question. How do you go about trading options early in the week, like on Monday and Tuesday, versus late in the week, like on Thursday and Friday, since the volatility is so different, meaning that time decay isn't as prevalent early in the week, so the stocks have to move more percentage-wise in order for you to get to the same return instead of Thursday and Friday, where the stocks only have to move a fraction of a percentage for you to get that same return, which is true. I have trouble getting, this is this person speaking, I have trouble getting larger returns early in the week because of this, not to mention premium is a lot more, so I typically only trade Wednesday, Thursday, Friday for options. Now this question, really what it's kind of dealing with to me, the week certainly has its impact, the timing of the week due to theta, as you point out in your question, but more it seems to me like, hey, when should I be going in the money on an option and when should I be going out of the money? When should I be willing to pay up in premium, and when should I be looking at premium as a red flag and say, nope, that's too much premium to be paying? And this is something I just covered in Watch Him Trade for premium users, but the content is free after it gets covered live. I just posted that link in chat, and it's the first question asked, so just start at the beginning of the video. And the topic I discuss, I go over 3 things you need to look for to determine, hey, should I be going in the money or out of the money on it? And just to kind of briefly summarize, the 3 things that you need are speed, range, and extension. Speed, meaning all of these time and sales windows right here. On Monday, Tuesday, and just any day, how fast are the tapes moving? That's what I refer to as tape speed. Number 2, range, okay? first few minutes of the day, how wide of a range has the stock traded in? And number 3, extension. Later on, 10 minutes in, 15, 30, 45 minutes, 60 minutes into the day, when the stock approaches high day or low day, does it break that high? Does it break that low? And then after it either does or doesn't, does it then extend well beyond the high and make a nice clean move higher or lower? Or does it maybe try and go up a little bit but then comes back down, back and forth type thing? Speed, range, and extension. Those are the 3 keys when it comes to navigating should you go in the money or out of the money. And again, I give much more in-depth analysis in the video I just linked in. In regards more to the specifics of your question as far as how do I trade on Monday and Tuesday versus later in the week, I generally find myself playing farther out of the money early in the week because there's a lot of time for that strike to realistically go in the money, and I end up getting closer and closer to the money as the week progresses, where by Friday I'm usually playing the first in the money strike or the at the money strike, the strike that would be next in line for being in the money. But again, it's more to me about, hey, what's the stock doing? It doesn't matter if it's Monday or Tuesday, Wednesday, Thursday, or Friday. It's more about speed, range, and extension that determine how I'm going to trade the options. The other thing I want to point out, since you brought up Monday, Tuesday, is we've been seeing some really good Monday volatility. If you just look at QQQ, for instance, I'm just going to circle the last few Mondays. Okay. You've been seeing wide ranges and just good action overall. All right, so just the last 6 Mondays, you've gotten some really good range in QQQ. I'm focused on QQQ because I trade tech, and most of the times when I receive options questions from you guys, you're generally trading tech stocks as well because they tend to be the most liquid options. So that's why I'm referencing QQQ. But you've traded in, this past Monday, 87.97 on the high to 86.96, 86.76 on the low. The Monday before that was just spectacular. 87.11 on the high, 85.11 on the low. The Monday before that was actually quite non-volatile compared to the other Mondays, but still 1% range, 86.84 to 86. The Monday prior though, 84.84, 85.44 high to an 83.91 high. The Monday before that, you had 86.63 high, 84.95 low. Monday before that, you had, well, that was another weak Monday, I guess. I circled the wrong one. But bottom line, 4 out of the last 5 Mondays, you've just had awesome range. So if you haven't been trading on Mondays because of, your beliefs about premium and whatnot, then you've been missing out on some pretty good trading. While you do make a completely true point that later in the week a stock might only have to move a fraction of a percentage move it made earlier in the week to get the same percentage return from those options, I'd like to remind you that that works both ways. If you are wrong, you will lose a huge percentage later in the week that you wouldn't have lost earlier in the week because theta is your friend earlier in the week if you're on the losing side, and it's very much against you later in the week if you're on the losing side. So kind of a double-edged sword there, and you only mentioned the positive side. You got to remember that it protects you as well. If you're trading premium earlier in the week, it's easier to manage your losses. Earlier in the week, I generally try and keep my percentage losses between 7 and 12%. Later in the week, especially on Fridays, as much as I'd like to keep my percentage loss between 10 and 15%, I accept mentally that, you know what, Kev, data's a bitch. It's expiration Friday. If you're playing options expiring today, your average loss, if you have them, is probably going to be close to 20%. If you can keep everything around 20% on the losing side, then that's still a solid job. So, I guess you could say that I've become a little bit more accepting of bigger losses later in the week percentage-wise, because the conditions of the trade are different. One of the things I would do if I was you, and I do this myself, is I would study your orders and see if you have more gains and losses later in the week versus earlier in the week. See if you can say, oh, I've been trading really well Monday, Tuesday, Wednesday, but not so good Thursday, Friday, and what that'll do is that'll give you some insight into, hey, maybe I need to adjust my size at certain points throughout the week, or maybe I need to be more conscious about my hold times at later points in the week, that, hey, I shouldn't hold for so long later in the week on positions, and earlier in the week I can hold for longer. But again, I really believe that this isn't as much about the point in the week as it is about what the stock price is doing, regardless of when it is doing it, when it comes to trading these options. And that video that I linked in will give you the insight you're looking for on that. So a couple non-trading related questions, but kind of more lifestyle and computer questions. Somebody wanted to know, how big is the monitor I'm trading on? Do I recommend having dual monitors, or do I recommend having just one larger monitor? Well, I'll show you my setup. I'm trading on multiple monitors, and I definitely recommend it. I think it just makes life easier on yourself. So you can see I have 3 monitors. The monitors I'm using are 24.5 inches each, I believe, and I have a stand that connects all of them. I just think it makes it much easier to keep track of everything as opposed to just one larger monitor. You can kind of have different screens doing different things. For instance, you guys are looking at my second screen, which is my chart screen. You can see I've got all my charts at the bottom, and then my main time and sales screen. My first screen, which I just dragged into the picture, is my individual stock screen where all my orders get placed. And then I use my third screen, which I'm dragging into the picture now, for futures trading, to keep track of the S&P futures, QQQ, and then other stocks that I want to keep an eye on, but I'm not necessarily trading, such as in this week it's been Solar City and Yelp. All right. So I just think it gives you more freedom and flexibility and allows you to stay more organized. I used to trade from just a laptop, and I look back at it now and wonder how I ever possibly did that now that I have these 3 screens. Also, Max, aka Madaz, wrote a very good article on just kind of equipment, the essential equipment you need, talking about some monitors and just your computer connection and everything. So you should check out that article. I just linked it in chat. And then if you want to know, what I use exactly, what did I buy, I have it all linked on my Pinterest page underneath my stock supplies. These are the monitors I bought, Asus monitors. This is the computer I'm using from newegg.com, and then this is the stand I bought for my setup as well. But definitely recommend at least 2 monitors. If I didn't have the third monitor, I wouldn't be looking at futures probably as much, but I definitely find it very helpful that I can keep track of futures as well. But at the very least, I would say if you can afford it, you need two. And if you can't afford it, you need to do what's necessary to make it so you can afford it, because this is your business. Trading is a business. You are a business owner, whether you're registered as a trader or not. Anybody who's here right now listening to me talk has an interest in being a successful trader, which means you have an interest in being a business owner. You need to think of trading as your business, and you need to invest in that business. So don't be cheap. You can find quality monitors online for as little as $75 sometimes. You know, mine I think only cost, I bought nicer ones, and even those I only paid $200 per. And a new computer, I bought a nicer one, but you can buy a new computer for $500 to $700. You know, a quality computer that you need. And again, if you want more insight, look at Max's article that he posted. I believe he tells exactly what his settings are in that article. Next question. Do you ever get eye strain from staring at your monitor for so long? If so, how do you relieve it? Well, my eyes are god-awful. My contact prescription is -5.5 on my right and -6 on my left. So it's just awful. If I take my glasses off, I can't even read the numbers literally that are 20 inches away from me. My optometrist says that my vision has deteriorated greatly because of the fact that I've been staring at a computer all day, every day for the last 5 years. 5 years ago, my vision was, -1.75, so it's definitely accelerated. And I've had a prescription since high school. But my eyes honestly don't get strained, though. At least I don't feel them getting strained, but my vision definitely gets affected. I was told, for people who also, maybe are like me and you have bad vision, I was told to wear an older pair of prescription glasses because that helps ease the stress on my eyes. So my contact prescription is -5.5, -6. The glasses I'm wearing when I'm looking at my computer during the day is -3.5 and -4. I was told that that kind of helps soften the damage to your eyes. Now, if you do get stressed, there's something called a 20-20 rule, which means that for every 20 minutes you look at a computer screen, you should take a 20-second break to focus your eyes somewhere else. Maybe, look out the window, focus at a spot on the wall, look at a painting, something of the sort, but it shouldn't be, at TV or, anything else that's kind of the same lighting as a computer screen. But it just kind of comes with the territory. I mean, most of the default settings are usually the best settings for the computer, but you can't do this without your eyes being affected somehow. And if you get strains or you get headaches or something, I would talk to your optometrist about it, because I'm not really as qualified to give a good answer, but that's what mine said, is the 20-20 rule. And another question, what have I found to be the best trading environment to trade in, as in the physical place I'm trading? Dark room, light room, office, living room, etc. Well, I've always traded in a well-lit room where my desk was against my window. I like having natural light. I really believe in having some natural light for me, because I feel like it helps bring energy to the environment I'm trading in, and I want there to be some energy there. I just find it more peaceful and enjoyable also to be able to kind of take a break sometimes and just look outside instead of having 4 walls surrounding me, and definitely get some light. You don't want to go crazy. Next question. It's a good question. This will be one where we've got some examples to go over. Are the summer months harder to trade in? And if so, would you advise that a novice trader begin trading during the summer? I would not say that the summer months are harder. I would say that I think market conditions are always changing. Sometimes the market is very volatile with a lot of stocks making moves. Other times it is not volatile at all and it feels like nothing is moving. Sometimes there's a hot sector where if one stock is doing well, then every stock is doing well. Other times individual stocks are completely influenced by which way the broader market is going. And if there's an uptrend in the S&P 500, then everything's going up. And if there's a downtrend, everything's going down. Other times, like what I believe to be now, you have the market in a channel and you're seeing a lot of stocks make up and down moves over a couple weeks without actually going anywhere on a net basis. For instance, you look at something like a Netflix stock. Over the last month, really, mid-April, when Netflix first got down to the 320s, it's made some good moves up to 320, or from 320 back up to 360 or so, back down from 360 back down to around 320, then back up to 340, then back down to 320. So you've had 1, 2, 3, 4 moves here. But in reality, on a net change basis, net change is when a net change means percentage movement from start to finish over a set period of time. So, for instance, taking the middle of April when you're first around 320 in Netflix, you've moved up a lot percentage basis. You've made big move higher, big move lower. But on a net change basis, you haven't moved from near that 420. Between here and here, you're still pretty much where you were, right around that 420 mark. There hasn't been a lot of net change. So that's the current market environment. So to me, I think the better question is, how do market conditions change in the summer? And are those conditions usually trader friendly? Well, first thing I want to point out is a monthly chart of the S&P 500, or sorry, a weekly chart of the S&P 500, because we will see that over the last few summers, there's been a lot of volatility in the market. So you start with July 2013. You can see this period here that I just circled, the market made, a lot of up-down action, 1700 down below 1600, but there wasn't any net change. But notice that this period here, which I'll mark as number 1, was a multiple month bottom for the S&P 500. Then you go back, you look at 2012. Again, summer months. You had some volatility. Okay, you went from up near 1500 to down below 1300, but then you came back up. Not a lot of net change. Up, down movement, not a lot of net change, but as I'll mark with number 2, you still had a bottom get put in. So the last 2 summers have seen volatility without a lot of net change, and both summers have marked bottoms for the market going into the second half of the year. Then you go back, you look at 2011. 2011 was interesting because initially, as you can see, I'm circling here, you started out very flat, similar to the last 2 summers, just kind of channeling some volatility up and down, but not a lot of net change. But then you got this move lower here in August, and you did have major downside volatility. So 2011 was a little bit different from 2012 and 2013. What I'd still point out, though, is that in that summer, while you retested the bottom back in October, you still had signs of a bottom in summer 2011. So the last 3 summers lately, over the last 3 years, you have seen bottoming price action. That's the first thing to be aware of about the summer months, and that'll be something to watch for going into this summer? Do we see another bottom or not? Also, what you've seen is volatility. There's been a general increase in volatility. If we look at a chart of the VIX, you'll see numerous peaks during the summers over the last few years. And then this is a huge one in 2011. So these are the same corresponding bottoms that we had. So bottoms in the S&P were coinciding with tops in the VIX, as you'd expect, since they have an inverse correlation. All right, so the first market condition that has showed up in the summer consistently over the last few years is volatility. Volatility is a double-edged sword for traders. To some, it is their best friend, while to others, it is their worst enemy. If you don't know how to approach volatility, or if it catches you off guard, then you can get killed. Remember, volatility equals big directional moves. Not playing big directional moves properly can equal big losses. The other side of that, though, is if you do play them correctly, you can have massive percentage gains. I personally think non-volatility is harder to trade than volatility. My reasoning is all about percentages. With volatility, I feel it's a 50-50 trade-off. You've got heads on one side, tails on the other. You're either going to be right or you're either going to be wrong, and it's up to you to recognize that and, trade accordingly. But at least, you've got a 50% chance of being right with volatility if the market is for sure moving up or down. With non-volatility, though, you only have a 33% chance of being right, because you could either move up or down, or you might just not move at all. So, that's just kind of neutral. So that brings a third element into the equation, which, instead of 1/2, 50% chances, now we have 1/3, 33% chances. So that's why I think it's actually easier or smarter to trade a volatile environment than it is to trade a non-volatile environment. Think about the penny market right now, for instance. The penny market isn't nearly as volatile as it was a few months ago. A few months ago, you had ERBB making huge moves, PHOT making awesome moves, GRNH, hemp, all those weed stocks were all the rage. We all know about that. Good volatility. All you had to do was be right. Get on the right side, and there was a good move being made. Now, you don't have a lot of volatility in the penny market. You've kind of just got slow drips lower. Everything's kind of drifted lower, but it's not super fast. And when they bounce, they're not bouncing super fast. There's a lot of slow-paced action. I would imagine, even though there's less moves being made, people are probably losing more money in the penny stock market today than they were 4 months ago, because they're probably forcing trades during non-volatility. Whereas during volatility, you're not as likely to force trades, because if you do get in a trade, again, you're either going to be right or you're going to be wrong, but at least you're going to be something. Whereas non-volatility, you really don't know what you're going to be, because it can take a lot longer. So, if this summer is similar to the last few summers in the options market and big boards where we do see more volatility, then I think it's actually an ideal time to trade, and do think a novice should be participating, because volatility can't intimidate you. It's crucial that you learn how to trade volatility. That's when you're going to have the most opportunities as a trader. So you need to learn that at some point. So to me, there's no better time to learn it than early on in your career, because that'll just give you that much more experience later on. Now, the key with my answers, though, is I'm assuming that you are managing your trade size properly and you're managing gains and losses properly. And those are two pretty big assumptions. So I have some videos that go over the management of each of those, size, and the trade itself. So I just posted them in chat. Really encourage you to watch them because, again, my answer assumes that the technique behind your trading is already solid. Next question, probably what I consider the most valuable question from today's webinar. What do I consider to be the most important thing that I do that makes me a successful trader? I treat every day the same. I prepare for Friday just as hard as I prepared for Monday. All right? This was my point earlier. Trading is not Monday through Friday. Trading is Saturday and Sunday. Trading is watching film on the weekends and getting better, studying charts, reading up on different techniques you're exploring to use. All right? It does not end Friday at 4 p.m. Eastern. That's when it starts, because for everybody else it's ending. But if you want to take advantage, get a leg up on everybody else, you've got to be doing what they're not doing. So for me, that's working my ass off all the time on the weekends, having webinars like this. I'm getting a lot of value for myself just out of saying my answers to you guys, because I'm hearing, hey, all right, these are the answers you think are right. It's giving me a responsibility to act on these own insights when the market's actually open. So I treat every day the same, and I work super, super hard. I always show up to work expecting to be able to make a good trade. I never have a day where I wake up and I say, meh, I shouldn't even go to work today. Shouldn't even trade. I should just take the day off. Unless it's like a planned vacation that, I planned ahead of time. But a lot of times I think people kind of just aren't feeling it sometimes, and they think, I'm just going to take it easy. It's like, you think Michael Jordan chose which playoff games he was going to get a good night's rest for and whatnot? No, it's like the man was prepared for game 1 the same way he was planning on preparing for game 6. I guarantee it. All right. Now, if the day starts off slow and I don't see anything after an hour or so, I'm not just going to sit here all day. I'll go chill out. But at first, I went into that day just as prepared as every other day. You never know when the best move of the week, the month, or the year is going to happen. And you will not forgive yourself if you weren't prepared to trade it when it does. So that's why you need to have a routine, and you need to prep every day the same. You need to treat every day with equal value, and that value has to be extreme, precious value to you. That is what I believe makes me successful and is the most important thing. Last question. How does one go about tracking and charting different sectors? Now, I wrote an article about this a long, long time ago, back in, I think, 2012 or something. There are these ETFs called spider ETFs, okay? And there is a sector ETF for each particular sector. So bear with me while I get this pulled up here. All right, so there's 9 spider ETFs, and these are great for tracking sectors. You have the XLY, okay. We'll look at daily charts of all of these. So you can see this is XLY. That tracks consumer discretionary. So you've got stocks like Walt Disney, Comcast, Home Depot, Amazon, McDonald's, etc. I'll post the link to those holdings here. All right. Then you have XLP. XLP is consumer staples. So your Procter & Gamble's, Coca-Cola, Philip Morris, Walmart, that's what makes up your consumer staples ETF. Then you have XLE, energy, for the energy sector. So this will be your Exxon, Chevron, Conoco, okay, you know, your big oil and gas companies. You've got the financials, XLF. This is going to be your Bank of America's, Wells Fargo, JP Morgan, Berkshire B, American Express. Then you have XLV, which is healthcare, which is going to be Merck and Pfizer, Johnson & Johnson, Gilead Sciences, Bristol Myers, Amgen, you know, the biotechs and whatnot. You've got XLI, which is the industrials. That's going to be GE, you know, General Electric, Boeing, United Technologies, what have you. You've got XLB, which is your materials ETF. That's going to be, I believe, oh, so CAT's not on here, but DuPont, Monsanto, Dow Chemical, Freeport, McMoran. All right. Then you've got XLK, technology, which is going to be, you know, Google, Microsoft, Apple, you know, the big tech names, IBM, Verizon, AT&T. You can see Apple is a big chunk of that. And then lastly, you have XLU, your utilities, which is, you know, Duke Energy, NextEra Energy, you know, your energy providers, PG&E, etc. So those are the 9 sector ETFs, and I'll post them in the chat. XLY, XLP, XLE, XLF, XLV, XLI, XLK, XLB, XLU. So that is how you track the sectors, okay, by being aware of those different ETFs for each sector. Most people probably don't even realize that you have these ETFs. Now, how is it useful? Well, what you can do is you can start comparing sectors to each other and try and identify, hey, which sector's in an uptrend, which sector's in a downtrend, and how is it, you know, corresponding with the overall market. For instance, we're looking at XLU right now. We're looking at utilities. Utilities are in an uptrend. You can see pretty clearly this chart is moving from the lower left to the upper right. So that means most likely that a stock like Duke Energy, which is a major holding of XLU, I would say based on XLU, Duke Energy is probably in an uptrend, so Duke Energy is maybe a stock I want to look to trade while the market's going lower because it's probably holding up. And you can see that Duke Energy is indeed in an uptrend as well, holding up, had a little dip, but maybe it's a good time to buy the dip on Duke. Whereas if you look at XLK in the technology sector, although Apple and Microsoft is heavily weighted in this, so it's keeping it afloat, but you can see XLK is completely sideways. All right, so I might look at technology and I might say, all right, the sector's completely sideways, so I should just be able to trade an individual stock based on its movement. It doesn't look like the sector's breaking one way or the other. So I've got a stock like Apple, which is in an uptrend, just broke out. I'm going to keep trading Apple to an uptrend. And then I've got a stock like Amazon, which is in a downtrend and broke down. I'm going to keep trading Amazon to downside. Although, sorry, I should not use Amazon because Amazon isn't a part of XLK, I should use a stock like Google. Google is in a clear downtrend here, so you've got Google moving from the top left to the lower right, whereas Apple recently has been moving from the lower left to the upper right. And that's exactly why you have the sector in general going completely sideways, because you've got a major stock like Apple in an uptrend, but then a major stock like Google, which has been in a recent downtrend. And if you just kind of continue it, you look at XLF. XLF, kind of similar to technology, was up a little bit, but now it's kind of gone down and maybe looks like it has a head and shoulders pattern creeping in. So I want to look at, hey, what are the weak stocks in XLF? Because if the sector breaks down, it looks like there's some really good downside here. So I see a stock like Bank of America, which has just gotten hit really, really hard over the last couple months. And if the sector keeps going lower, I expect Bank of America to be a leader of that sector. Whereas a stock like Wells Fargo is holding up really well and is actually consolidating near its highs. So if the financial sector breaks out, I expect it to be behind the leadership of a stock like Wells Fargo. So by tracking the different sectors, you can track leadership and just outperformance versus underperformance. And it can help you with your trade ideas and your execution as far as knowing, hey, if the sector goes this way, this is the stock I'm looking to get hit. If it goes this way, this is the stock I'm looking at to benefit from it. Those ETFs can all be very helpful, in kind of choosing where do I want to be playing. All right, that is it for questions. I had only one chart request. That request was on TTDZ, Triton Distribution Systems. Well, I see a nice pattern of higher highs and higher lows here over the last few months. So that's good, especially considering the penny market has been so crappy. So this is possibly a strong stock to hide out in. And the other thing I like about it is it's right around a round level, 3 cents. Simple. You're right at 3 cents. Are you staying above 3 cents or are you staying below 3 cents? If you're staying above 3 cents, then you're going to make a move back up higher, challenging the 4 cent, this resistance here between 4 and 4.5 cents. If you are staying below 3 cents, then you're going to make a move lower with key support right around this low from early April at 2.5 cents. And if you were to break down there, you're probably going back into this support range between 2 and 1.5 cents. So I would say, given the trend, it's probably going to be to the upside because that's what it's been doing the last few months. However, given the fact that the penny market has been awful, maybe not. Maybe the interest comes out and it trades back lower between 2 and 2.5 cents. What I like, though, is it's simple. You're right at 3 cents, good clarity. You know what you should be looking for. Can it hold 3 cents? If it is holding 3 cents, then it's going to go higher. If it's not holding 3 cents, it's setting up to go lower. If it's just kind of in between, 2.8, 2.9, 3.1, 3.2, keeps bobbing back and forth, not giving anything clean, then just let it work itself out and wait. But I like this setup because of where it is on the chart. With my big board trading, I love when a stock is near a round level. For instance, Apple has been a really easy trade lately because it's been near, easy 5-point marks, whether it's 600, 595, 590, 585, 580, 575, what have you. It's been really nice. You've just been able to say, all right, as long as it holds 590, it's going higher. If it loses 590, it's going lower. As long as it's holding 600, it's going higher. If it loses 600, it's going lower. And I see the same type of potential with TDTZ relative to 3 cents from just a easiness perspective. Nice and clear.